Okay, what's up, guys? It's Colin again. I was asked to do a video on iron condors by someone in our TW group. So quickly, what an iron condor? We have it right here. I think we're on something like AMD. Probably switch that to bigger stuff. So what an iron condor is, my last video or one of my videos, I went over a short call spread and a short put spread, excuse me. And so it's just a combination of the two. And just personally, even though this is a short option heavy strategy, meaning the short options are bigger than the long options, which I would tend to like, I just don't do a lot of iron condors. I tend to get called out on the call side. I like to just play directionally that way. If I'm right, I don't have to worry about getting caught on the other side. With strangles, because there's not the long option component right here, it pushes the break even so much further out. So people ask me, well, if you like strangles, why don't you like iron condors? It's a similar thing. Well, not really. Because the break evens are pushing so far. It's also defined risk, which is a difference. Strangles are undefined risk, specifically on the call side. And so we look at this 60% probability of profit right here. You could do what's called a one standard deviation. Iron condor, so you get a $10 spread, so 230 to 240, and 315 to 325. Now this is going to, on a $10 spread, you have about 70% probability of profit and a $212 credit, which means 212 minus the difference between 230 and 240, which is 10, about a $800 loss, $788 loss. If you go into the Greeks, now obviously you do get a credit because these short options, which are those red options, I'll show you. These are closer to the strike price than the long options. The long options are really just here to define our risk. Again, if these weren't here, this would be a strangle, and the credit would be bigger, the theta would be bigger, the delta would be, everything would be bigger. But with that long component, it takes a lot of these. It cuts them down. You can see here the delta is actually about a -1 share of Facebook sold short, so it's about even though. And the theta is about 3.6 a day. So with spreads, with iron condors, it really, in my opinion, it just takes time. Now, if you do, let's say, a short put spread, which is just these two and not this, and stock goes from 270 to 300, you can get out of this obviously a lot quicker than with time. But since it's got to kind of stay in these ranges, it does have to stay in there for you to make money. But for you to buy it back, before expiration, $3.68 a day. It's going to take at least, in my opinion, 2 weeks, about 3 weeks to get a good profit out of there. Now, Tasty Work Mechanics says you should close at 50% profit. So you can set that on there and you sell it 45, 50 days out. So I'm going to do a quick, again, I don't use a lot of iron condors. I haven't had success with it. Sometimes they do, but what I'll do is a strangle. Now, the reason I do a strangle, and I'm going to show you that real quickly, is, I did a couple videos on this, but just same stock, same everything. You see, let me change the time. So same time, same everything. The credit for being much further out is much higher. My probability of profit is 88%. So let's just do one standard deviation. That's a good, way to. So 240. So I get almost a double credit, more 7% probability of profit increase, and delta is about the same. So about neutral delta. But look at the theta. Look at that, $16 a day, an increasing rate. So this is why I choose this, because you can hold these for a day or two. I'm not recommending that. And with the Vega crush, which means UVXT ticker VXX goes down because Vega is such a big component with just short options. When you don't have long options to counterweight it, then the Vega's big. Now there's some risk involved with there that someone asked me to go into. Short options have inherently a lot of risk. Now, when I say sell them, I'm not saying that in many ways they are more risky than long options, because hypothetically, say stock, March sell-off, stock goes down to 210. We have to take the shares at 210, minus the credit, of course, but be like, what, $3,000 or something, or more than that, excuse me. Let me see what it would be. Long story, it's you have to take the credit received. So 240, if it went down to 210, it'd be 30 times 100 minus the credit received. So you see where I'm going with this. Specifically, I think it's dangerous on the call side because, in my opinion, the put side's eventually going to get backstopped because markets tend to go up, random walk with an upward drift. But the call side, especially in this market, we could be way up here and it could just keep going. You're going to have to be very careful. I know I'm doing a video on iron condors, but if you're going to use a strangle, someone asked me to talk about this. Be very careful if you're using undefined risk stuff. This gives you the obligation, not the right, as with long options, to either take the shares on this side or give the cash on this side. And it looks good, 76% probability of profit. You're burning $16, $20 a day. It looks good per one lot. What I would recommend if you're going to do it, I recommend 5 delta. Go out something, I usually do 1 standard deviation here and 2 here. And, define your risk. Maybe you define your risk on the call side. Do a long option up here. Maybe, you define both risks. Do a 225 long option and 275. It's called a synthetic strangle. What that means is it's technically an iron condor because you have the long wings up there, the long options, but they're so far out that they don't really have any consequence other than to protect you from a massive move either way. I think it's important to buy the wings. I don't do it a lot because here's the thing. When I sell a 1 standard deviation strangle and or 1 here on the put side and 2 on the call side, I'm prepared to take the shares here. If you're not, then maybe you want to. You don't think you can ever go wrong buying the wings. You're still going to make money. But I don't. The reason why I use a strangle is that if you buy them too close, like we did like a $10 spread, a $5 spread, then it's not really a strangle anymore. It's an iron condor. And the thetas that you had, because the probability profit goes down, the theta goes way down. I mean, it's just, it's not my cup of tea. So that's the thing on iron condors and strangles, which is an alternative to an iron condor, which just has the long wings. Again, we want to be very clear about this. Selling short options has a lot of risk. It costs a lot of money. But I'm going to do a whole video on the risks between long and short options, just because I want you guys to understand that everything. If you get a high probability of profit, a big credit relative to the stock price, there's a reason for that. It's because there's a lot of risk. Now, it's not going to happen very often, but you need to be prepared because it will happen eventually. That 8% sell-off, 3 or 4 months ago. If you had a bunch of short options, specifically puts, you were having a bad day because the Vega went up, and Vega is a part of the options pricing. And so when Vega shoots up, typically on a big sell-off, these options will double, triple in price just from the Vega. And the theta is not going to offset you, much less the delta. They're going straight down. So just be careful. I'm going to do a whole video on it. But again, to bring it back full circle, if you're going to do iron condors, I like to do a $5 wide spread on each side. So 45 days out, roughly, I might go a little bit 60, something like that. 1 standard deviation, $5 spread looks like this. Just like this, right? And $105 credit. Typically, you want to collect, around 150, 140, 160. But just to show you guys, 1 standard deviation. Maybe move this in a little bit, and this is what it looks like. It's about 68% probability of profit. And the delta is about neutral. You do it delta neutral. I'd like to maybe do a little delta positive, but theta is going to be smaller, but it's still going to be positive theta, so you're still going to make money at the time. And how you manage these, you close at 50%. For me personally, if you're up 25, 30% quick, I close it. That's just me personally. There's a lot of risk, not undefined risk, but if it goes up, or down, I just don't like it. I think the short options are too close, and you don't get enough credit, which boosts the break even, as opposed to a strangle or a synthetic strangle with wings, but the wings like maybe out here. This is a synthetic strangle, so you guys know what I'm talking about. Anyway, I covered a lot in this video. People have been asking me to cover, just to cover the risks of short options. So I'm going to be going more into that. I want you guys to know exactly what you're getting into. If you don't know, obviously you don't have to do it, but maybe just start with 1 lots and, go from there. Anyway, thanks guys. Let me know if you have any other ideas. Thanks. Bye.